when I spoke at the Big Valley Conference at the California Credit Union League, and I talked about the fact that they had a regulatory tax. I believe, Sarah, you were there, weren't you?
Probably.
Yeah. And what I said was, you have a regulatory tax. Your tax exemption is keeping you back with regard to your business model. You want to evolve, but you can't. Part because us, in the banking industry, we're going to fight you tooth and nail as long as you're tax exempt. But also there's a general view in Congress, you will listen to it, they're saying, if you want this ability to engage in expanded powers, you need to become taxable as an entity. The same thing's applying with regard to capital. We are now seeing more and more credit unions who are recognizing that they need access, to alternative capital. And what's occurring is, once again, your tax exemption is keeping you bound up and is limiting your ability to gain access to that capital. And what you have to recognize is that this is effectively a growth tax on you. Your ability to grow is limited by your capital, and you're paying a tax because of that. And so what you have to recognize is that there may be a case where there is a trade-off. That we lose this regulatory tax in return for being taxed on our income. And what you would end up doing is treating this as a normal business expense. So this is kind of where, from my standpoint, where you're looking at. This is the 800-pound gorilla in the room. People need to talk about it, need to be frank about it. And like I said, the Canadians, they dealt with this back in '74. The industry changed fundamentally. I think you saw consolidation take place. But I would also argue that the consolidation probably led to stronger institutions.